So standard disclaimer, get past that slideshow here. And we're off. So around Thursday or Friday morning, I get an email from Mark asking what the topic is or the subject is for the presentation. I didn't have one on Friday. I didn't have one on Saturday, Sunday, or Monday morning. So you've been warned on this one. So I'll put it that way. But part of the reason is there's so much going on and there's so many different topics to cover. What I really wanted to touch on today is three things. Talk about the diverging views. We're all live in the same world, but we see things so differently today. And I have some numbers from the strategist to back that up. I want to touch on European competitiveness. It's getting more and more attention. It's something we've talked about for some time about the challenges that Europe's going through. And then we have the big meeting with President Xi and President Biden, which was long overdue and quite important for the globe. So we'll touch on that briefly as well. But most of the time I want to spend on the divergent views. So there's a lot of big issues out there. U.S.-China relations, I think, are at the top of the list. Obviously, what's the outlook for inflation? Still on top of mind for people. We have all these conflicts going on, but behind all those conflicts is this big battle between ideologies, and a lot of that is about the U.S. And China relations, but it's more than that. It's China, Russia, North Korea, Iran. It's how do those worldviews line up with the Western worldviews, and what do we do about it going forward? You had a downgrading by Moody's of the U.S. credit rating from to negative from stable. I also noticed today that they lowered Catholic universities' credit rating due to debt problems. So not even the Catholic Church is avoiding some of these challenges. We have massive consumption still going on, even with the strong headwinds that we're facing, which is really confounding a lot of people and has people wondering, when does the shoe drop? Do we have a cliff issue there? And then just in general, people have been fascinated, and I have been as well, about how the global economy has absorbed the body blows that we've had of the slowing growth and these high inflation and these conflicts, and how we've managed through that is quite fascinating. But it does leave us in a spot where we do see the world very differently depending on people's seats. So just looking at the outlook for rates, this is the market's view of rates and rate cuts for the Fed, what they are pricing in. And as you can see, as we're going forward, they're looking at 75 basis points of cuts by the end of next year. But what we're starting to see in the last 2 days, you've seen some big calls by some different leading Wall Street firms and how they contrast with the Fed. So they're going out now to year-end 2025 on the Fed funds rate. The Federal Reserve, the FOMC, is at 3.9%. Morgan Stanley has been quite bearish, is calling for the first cut in June of next year. I think the Fed's first cut is in the second half, and the Fed's only looking at, right now, 2 cuts in the second half of next year. Morgan Stanley's looking for the first cut in June. And by the end of 25, we'll be down to 2.375% on the Fed funds rate. So that's a long ways to go from where we are. We're about on, around 5 now. So pretty big drop. Goldman Sachs is much more in line with the Fed. They're only looking for 25 in Q4 of next year, with year end above where the Fed's target is, around 4%, but right around where the Fed is, plus or minus. And by mid-year of 26, they don't see it getting down to 3.5 to 375. So very different view from Morgan Stanley. And then UBS came out yesterday with their first view, and they think the first cut starts in March, and that next year alone we'll have almost 300 basis points of cuts. And by mid-year 2025, they'll be at 1.25%. So these are some of the leading firms on Wall Street and the Federal Reserve with massive resources seeing the same world very differently. So let's take another look at what they're seeing. These are, again, their 2025 year-end forecasts. And on Fed funds, they're all over the places we just talked about. But I think the real issue isn't inflation outlook or even GDP. It really is their views on unemployment. And you're seeing that Morgan Stanley and UBS are way up there. Morgan Stanley a little bit above the Fed, but well above Goldman. But UBS at a 0.7% difference in unemployment is a pretty significant difference to think about. And it just speaks to how negative they are about what the world looks like then versus the rest of the street. I would say for ARS, we're more aligned with the Fed. We think that for all the criticism they get, they've called it pretty well. They couldn't help the amount of fiscal stimulus that was going into the system. They could have adjusted to it, but their job is not to react to the fiscal stimulus. Their job is to fight inflation and focus on full employment. They had a big fight on inflation, which they seem to be doing quite well on, but employment is very stubborn. And with the unemployment rate as low as it is, one of the challenges is how do you get to a system where you start to see some of the easing of inflationary pressures because wages and income aren't keeping up. We're not in that mode right now. And this is what's really confounding the markets, I believe, is the outlook for unemployment, which is driving a lot of what the outlook for inflation is in Fed funds. So very different worlds that we're seeing, but it's the same world that we're all looking at. So I find it fascinating to see the divergences there. Switching gears to one of the other big topics that's on people's mind right now is the rise of interest rates and what it's doing to the amount of debt that's in the system and what debt's doing in terms of the challenges it's creating for governments. And just looking at what the US government is seeing in their net interest payments and going back to the 1950s, you can see how dramatic a spike we've had even after the pandemic hit. How much we've moved up since then with the wars and the pandemic. So you've seen a big move up, almost doubling of the interest rates payments. But what's fascinating is for most of the period from 08 to 19, we were looking at an interest rate on our interest of about 1.6, 1.7%. That's moved up now to 3%. And as we roll off all the short-term debt that we have, because we didn't lengthen out our maturities when we should have, we're going to be looking at even some higher costs, which is why, in our view, the Fed has to start to hold the line on rates and really bring down their balance sheet because they're worried that the crowding out is going to be too much for them if they don't get their house in order. And I think this is a big part of the debate in Washington, D.C. right now with the Republicans, although they're going about it in a pretty unusual approach, acting as if they weren't part of the reason that debt has grown the way it has. But if you look at our debt problem, it goes back multiple administrations and really goes back to the early 2000s. So we're not alone in this issue, though. Look at interest cost around the world, and what that's doing is this is a percent of GDP. And in the 25 low-income countries, which is the blue line, you can see closing in on 10%, and that is a big crowding out when 10% of your GDP is going towards net interest payments. Just think about that as a household expense or a corporate expense, and you can see some of the challenges that exist out there. So we have a debt problem. We have to get our debt in order. We have to get our fiscal regimes in better order, but we're doing that against a time that the populations are looking for a lot more. And that's a problem around the world, and we're going to have to make some hard decisions as government leaders. And as we're going into election years in a lot of nations, that's not the time they make hard decisions because they're more focused on getting reelected. We really need some one-termers to go in and fix some of the problems that we have around the world. Switching gears to Europe and EU competitiveness, and this has been a topic for me for quite some time. I think the European situation is really challenging, and I think Mario Draghi called it pretty well. Europe has been in losing their competitiveness basically since the euro was launched, and I think it has to do with the construct of the euro. They needed a fiscal and monetary union to make it work right. They stopped at the monetary union and didn't do the fiscal, and that's why we're dealing with some of the problems that we've had. And you saw how that problem was really tearing apart the fabric of the European project back in 12 and 13, when you had Brexit and other issues at top of mind. Ironically, you could say that the European project worked because the discipline that Greece put in place has helped turn it around. but you have other countries that are struggling still. So I think that's a challenge. I think Europe is also, like many places, facing declining loan demand. I think part of that goes back to the financial crisis again, and how they bailed out the banks in Europe versus the way we recapped the banks in the U.S. And we forced them into a position that they, in the U.S., said put them on better footing going forward. I think we short-armed it in the EU, and I think that's part of the challenge. So what I think happened back 10 years ago is the EU did enough to stop a debt crisis, but not enough to put it on a path for sustainable growth. And those are two very different things. You're preventing things from getting worse as opposed to putting things on a path for success. And unfortunately, because of the way that was done and because of not taking the pain when we needed to take the pain, we're now in a mode through fiscal stimulus that's been done around the world to support the populations during this difficult period. Now the expectations for social demands in governments are much higher, and they're in conflict with the structural needs and the pain that needs to get through and be taken on by the population, by the governments, by everyone, to get your country's balance sheets right-sized and get on a more sustainable path to growth. And you're having that now with an energy crisis, with a war, and with other challenges. And I think the three big ones are climate transition is not going as planned. Europe is a leader in that area, but we're dealing with some of the transitional problems and the ideology versus the practical planning issues there. We have big needs to increase defense spending, and now you have a potential wave of new immigrants coming in due to the conflicts in Gaza and the Middle East that could even put more immigration problems going forward, which is a big area of social conflict for governments, yet a needed area for growth because we have a population decline there. So I think Europe has a number of challenges, but I think one of the big ones is the carving out of the manufacturing base, which was such an economic engine, and the lack of industrial policies to counter what we're doing with the Inflation Reduction Act, what China's been doing with their government support of key industries for some time. I think there's a competitiveness problem that is somewhat external and a lot internal that the EU has to work through. And these are not easy challenges to solve. The other problem in Europe is their engine, which is Germany. Their economic engine is struggling. As you can see here, they're in a contracting state right now on the economy. I think there's opportunities to turn things around, but again, we're facing a winter that we have to navigate through this winter without any energy crises coming our way. And with what's going on in the Middle East, with the ongoing conflict in Ukraine, I think that could be a challenge. So something we're watching closely. And then it brings us back to the US and China, which is a fascinating dynamic. But I recalled this quote from President Xi to President Trump back in 2017, where he said there's 1,000 reasons to make US-China relations a success, but not one reason to break it. And then both countries proceeded to do everything they could to break it. Whether it's the trade wars, the sanctions, the spy balloons, the tit for tat that we have going on with politicians going to Taiwan, or what China's doing on their side with their warrior diplomacy. But the real issue is right now is both nations have come to realization that they need to put a floor in relations. I think part of that is political, that the leaders are weak at home. President Xi, while he is in as strong a position as a leader could be because of the construct there, I think he's losing share of mind. And you can do that for a while, but you can't do that for an extended period when the promise is broken, as we talked last week. If the population feels the commitment for a better life is not there for not domestic freedom, that trade-off creates a lot of social unrest. And I think that's something we have to keep an eye on. I think President Xi is keenly aware of that and is working to mitigate those problems. They just announced another 137 billion of support for the property market, which is the big Achilles heel for the economy right now. But they are doing a lot of steps to get the bottoming in. I think it really is up to the US and China to lead. We both have needs of each other. They're two big markets for each other. And I think the realization is starting to come to people in both administrations that a breakup of the world into a bifurcated state would not be good for either one of them. I think while China's focused on their global leadership role, the domestic stability issue is first front of mind for President Xi. I think President Biden has a different issue. He's in, in a weak spot, although he did, the Democratic Party did do well in the election last week, but neither guy is coming from this from a position of strength. So how do we move forward, I think is going to be the big issue for both nations. At the very least for the rest of the world, that the fact that we're talking again and putting a floor in relations, I think would be a big positive as we head into next year. And if you can get a floor in China and you get a peak in rates, then I think you can get a stronger equity market and get to more really reasonable valuations in equities, both private and public, that'll push us on a more sustainable path. So where we're investing is the same places we've been for some time. We still like healthcare, we like tech, but really it's about the industrial complex, including defense and reshoring that's going on, particularly for the US. We think the energy transition is painful and going to go on for a lot longer than people would care for it to happen. But I think that mindset adjustment is coming. And as that comes, it'll get to where projects are looked at in a more realistic way and valued on a more realistic approach. And that will help us make better investments going forward. I think the materials area continues to be a fascinating area and one of the key geopolitical footballs that will be playing out that you'll see going forward. And a lot of transactions I expect will be going on in those areas. You just saw Glencore announce that they're buying a coal part of Teck Resources business out of Canada. So the area you wouldn't think people would be running to, coal, has been in 2 transactions in the last 2 weeks. One was a coal find on top of lithium. And now this one is coal for coal's sake. So I think you're seeing some really interesting things going on in the materials sector. I think one of the most important things to look at right now is how people are handling their balance sheets and their debt loads and buybacks. And one of the things we're looking at is, and encouraging some companies to do, is to stop their buybacks and replace their underwater debt and buy in their underwater debt and make big savings and reduce their debt costs and improve their balance sheet that way. We think there's a lot of creative things that companies are going to have to do, but this is a balance sheet environment that we're moving into, and the move up from 0 to 5% is a big driver for that. And I think the balance sheet issue and the low growth issues and the forecasts are why we're seeing companies on earnings announcements having moves of 25 to 40% in either direction. It's because of their ability to fund their business, and ongoing concern issues, whether it's public or private, is a big part of that. So really focus on the debt side of the balance sheets right now. We think that's going to be very informative for where opportunities are going to be. We would be avoiding, for those reasons, the extremely low and extremely high PE stocks. It's not that you can't make money in them, but you can't go in thinking that you have to go in much deeper in what you're looking at. As we just talked about, the debt is one element of it, but there's so many other elements that we have to look at. So we're generally favorable on the environment. We think that the US is going to continue to attract capital from the rest of the world. We think the rate differentials are going to continue to drive capital here. The geography and our energy independence is another thing that gives companies a lot more confidence in where they can invest. And I think the European Roundtable, as we've talked about in the past, was very clear that they see a lot of new investments from European companies coming into the US because of concerns about geopolitics, because of concerns about energy, and because of concerns about being closer to the market that they want to be in. So we think this is a really interesting setup going into the end of the year. We're generally positive on it. We're cautious because of the geopolitical situation, but that appears to be remaining contained for right now. So, Mark, I'm going to stop there and we can open up for discussion.
Sounds good. Thank you, Stephen. Questions, comments? Adam Blanco.
Stephen, it's Roger. Thanks again for the presentation. What do you think accounts for such a divergent set of viewpoints on the trending of interest rates in the next 18 to 24 months on Wall Street?
I think it's fascinating. I'm not sure how people are coming up with such wide swings. I think part of it just is the seat you're in. I when I look at the UBS number, and I don't know the people that did this. I'm sure they're extremely good at this. They've been doing it for a while, but I think part of it has to do with the seat you're in at the time. And UBS is in a kind of a funny state, right? With their mergers and where they're coming from with Europe. I don't know if that plays into it or not. I think it's just some people, I think the range of outcomes is as wide as it's ever been. And I think the geopolitical elements, the technology advances, they're so unquantifiable right now that I think that's what leads to the range of outcomes and the extremes in their views. I think that's the main driver is you could see it going, you could make a case for the Fed losing control on interest rates or central banks losing control on inflation, but you can make the case that they've actually done a good job and it's coming down. I think the troubling thing is it goes to their views of unemployment, as I have up here now. The difference between 3.6 and 4.8 is really between Goldman and UBS is really telling. That's a strong view of where things are going. And part of that goes to wages and how people are going to survive the wage increases that have been going through the unions. And does that flow through to the rest of the economy? And even in the auto sector, we haven't seen that really take off. I think Honda and Toyota, instead of 25 or 27% increases, have already announced 11% increases or 10% increases for the U.S. workers. So they're getting ahead of some of the concerns, but they didn't solve that problem for the Honda or Toyota workers. So I think those are the issues of your outlook on unemployment. Growth is the other element of it, and you can see in the growth numbers that's what's driving it. But I think inflation is interesting. It's all pretty aligned where they see that, but I think it's the unemployment number that's the big one.
Adam?
Thanks.
Yeah, thank you, Stephen. Roger actually asked one of the questions I wanted to ask, but good response. So 2 questions. First, you said earlier loss of competitiveness with the launch of the euro. Can you expand on that a little bit? The second question, which relates to the question that Roger had asked, and that is the influence that the Federal Reserve has over global interest rates. My first job out of Banco do Brasil was my boss said to me, when the United States has a cold, the rest of the world has influenza. And he was also referring to the interest rates. Has the Fed lost? How influential is the Fed on the global interest rates?
2 things are very influential on global interest rates. One is the Fed and the other is the US dollar.
Right.
The dollar strength actually, the dollar is a benchmark exchange rate for several other countries. So that is part of it. But, and because of goods or commodities are traded in dollars primarily, that is part of the reason for that. I think the US has been the primary issue, but I think that's changed as the rest of the world has come up. And as you look at the BRICS Plus now that are forming, they represent over half the GDP. So I think you have to think about it a little differently than you have in the past, but it's still the benchmark rate. And that's the case when conflict hits. The importance of the US treasuries and the dollar when conflict hits, our safe haven status really steps up. And you saw that with the drop in rates that we've seen from the attack in Gaza and Israel to now, the 41 basis point drop or more now on the 10-year, and the 31 basis point drop on the 2-year, I think is a reflection of that. So that's the second question first. On the loss of competitiveness, I think the EU was the right idea, partially executed. It reminds me of watching the Jets play in New York, or any of the sports teams play. If all 11 aren't working together, you don't get the result you need. And in this case, in the EU, you had 27 nations, all with different needs for their own populations, trying to work for the good of the broader, a couple 100 million people. It doesn't work well that way. And I think that the structure was flawed from the very start. To have a monetary regime, but not supported by a fiscal regime, makes it very difficult to manage the economy. On the other hand, it was taking the power away from the population, who didn't want to be beholden to other nations in their union. So it made it a very difficult thing from the start. And then you fast forward to the war and all the other things. Where was the economic engines in Europe, and what were we doing to support those industries, and how did they play in the advanced technology industry? So, you think about the EU started when 96, 98. I forget the year exactly, but think about the tech transition from there. And Europe has good pockets of technology, but they don't have a tech sector or industry to compare to the US or to China, or to other nations right now either. So I think that it's part old industry falling behind, and part new industry not being there, and part construct. And then it's the political will to work in a union, which when you had the stresses, let me rephrase it, Adam. The simple answer is the EU wasn't designed for crises. It was only designed for good times. So when the crises hit, they were not set up for that. And they're struggling with that and dealing with that and moving forward as a result.
And they're going to struggle more with expansion, as they already are struggling with expansion.
Well, if you bring things into it, if you have a sloppy setup and you bring other things into it, doesn't get cleaner. Generally, it usually gets sloppier. So I do think you're adding more conflict into it. And I actually think that some of the economic challenges that Europe's having are going to set them back on their ability to get their defense spending up to the level that they need to, which is interesting depending on the outcome of the 24 election in the US, how much they might need to or not.
Yeah.
So I think it's a really challenging setup for Europe. And I think if I was a European citizen, I would be really focused on who I elect next. I would also do that if I was a US citizen, but unfortunately we're down to 2 choices right now that are not looking particularly spectacular. But I think leadership is going to matter as much in the next 5 to 10 years as it has in the last 50.
Thank you, Stephen.
Other questions, comments? Everything's clear?
Thanks for coming.
This crowd doesn't let that go that long.
No, they're worn out.
No, crystal clear. Thank you, Stephen.
Thank you guys for coming back.
I'll switch it to everyone else. What are other people, what scares and excites people today?
I find exciting the prospect that neither of the 2 leading candidates in the U.S. will be on the ballot a year from now. That's exciting.
Let's bet a case of something on that one.
Okay.
Yeah. Your lips to God's ears.
Anyone else?
Mark, I didn't mention it, but we're pretty close to another shutdown too, which I didn't cover. But there's a good chance the U.S. government shuts down again. in
I
some.
saw Moody's put us on a negative alert.
Yeah, hasn't changed behavior. And Janet Yellen came out and said that we're in better shape than Moody's thinks. But I'm not sure that Janet Yellen wasn't a much better Fed chair than she probably might not have been best to go into politics.
Could be.
Did you see in the journal this morning the not shift, but the investment by Exxon into the lithium mining?
Yeah.
They're at least thinking ahead. They're not like the railroads when cars came out, just saying, yeah, that's never going to go anywhere. They're starting to look at how do they participate in the non-oil and gas world.
They've been doing that for a while, and some of the others.
This looks like a big one, Mark. I mean, huge investment, and they're making it public now.
Well, that I mentioned that with Glencore, but you'll see a lot more of that. I mean, there's, I think one of the challenges with the energy transition is that the companies that are starting up in that area are dealing with startup costs and all that, where when you can get somebody like an Exxon with deep pockets and a rich balance sheet, that's what you need for a lot of these transitions. You need the runway. And I think you'll see some more strange bedfellows like Glencore and Teck and Exxon with this lithium transaction. But I think you'll see more of that coming. And Mark, you had Chris White, I think, had a company last week that he's been promoting to the group as one to keep an eye on. That's a coal company, a coal mining company that might be sitting on a $36 billion worth of rare earths. So
Chris would like to say that he dumped the stock yesterday.
Oh, you did, Chris?
Yes. Geez, guys, it's amazing what an article in the Wall Street Journal will get you. The rare earths in the clays surrounding coal deposits are relatively common.
Mm-hmm.
This happens to be a very big coal deposit, and accordingly, a whole lot of rare earths.
Mm-hmm.
The concentrations of rare earths in the clays surrounding this coal are about 2 orders of magnitude lower than a hard rock rare earth deal. And there is, to my knowledge, only one mine in the world which is actually removing rare earths from clay, and that's in China. And no one in this country has a friggin' clue how they're doing it. So this is, I think this is an excellent case of, sell on the press release, so to speak. And I would think that if there ever is a project that's developed here, you can buy back into the stock sometime over the next 10 or 15 years.
Probably multiple times, Chris.
Probably several times, Stephen. You're exactly right. So, I appreciate your bringing it up, Stephen, and I would like to tell everybody this looks like a good exit point to me. So
yeah. Well, I noticed when you brought it up before, Chris, people were taking notes. So I wonder how many people went in.
Well, I know some did, because several people have said so to me. And so perhaps it's a good idea to, how do we let them know this is a good exit point, Mark?
That's why I raised it, Chris.
Yeah.
That's one that, Chris, that stock popped 35% that day, I believe, or was it higher?
It was more than that. I think it went
40.
from 8.5 to 16 or something.
Yeah.
Even, I mean, it was ridiculous. And the article I mean, my God, the article was something in the nature of a hagiography. It was unusually complimentary, shall we say, right?
Yes.
Yes. So, you know, and this is a little tiny company with not much trading volume. You know, if all of us on the phone here went out and took a position one way or the other, you know, we could move this market in a heartbeat.
Yep.
That's
But
what
we're
happened. That's what happened. Yeah. So anyway,
Oh,
I suggest if you bought any, I suggest this is a great moment. Sell some.
So I'm gonna, if you want to hear more from Chris, here's Chris. He's not on camera. He's usually on camera.
My camera on this damn computer is busted.
That'll happen. And so Chris and I have known each other for a long time. He calls a lot of things. So stay close to Chris. You might have to go outside and have a cigarette with him to stay close to him, but you know, you can stay close to Chris.
I would say, Mark, this does highlight, I think, one of the transitions that investors have to make, which is it's not going to be either or on fossil fuels and renewables. An energy transition requires everything. And I think ESG and the people leaning that way should be thinking about how they think differently about what ESG is and the role of fossil fuels in it. Similarly, on defense, I think the investments in defense, if you ask people in Ukraine or other countries in Europe right now, if they think investing in defense is a good thing or bad socially, I think you get a very different view. So I think we're in one of those periods with all the transitions going on that we almost have to rethink some of our basic beliefs and make sure they're still aligned with the world we're in today.
Well, it makes me
I
want to.
would say one thing about all of these transitions,
Yeah.
which is, given the state of the deficit, given the fact that we have to refinance, I think it's $8.2 billion or $1 trillion of debt in the next year, plus whatever the deficit is during that period of time. We have a lot of unhappy choices that are going to have to be faced here in the relatively near term. So it's going to be a bad time to be a politician.
We've been talking about energy transition, which Chris has said that's the wrong word. There is no transition, but there is, at least it's a long one for sure. It was 2 years ago at our conference that Greg Schuler, the former CIO of the University of Pittsburgh, was on a panel with, I think you were up there too there, Stephen.
Yep.
Burke.
He took me out of the seat. There I'm back.
Yeah. And I was just reflecting, if you guys want to hear watch an interesting one, it was last year, right? Was it this panel where Chris was speaking? Nah, I don't know. Yeah, I think no, it's not that one. But it's a topic we've been talking about for a while. And I will say this, and I was telling Chris, so many at Super Return, I heard upstream energy investments for the first time. And not once, 3 or 4 times.
Yep.
It's back.
Now
I
would say here again, the world's going to use more oil in 2050 than it does today. You can write it down. So I know that that would have seemed like a silly thing to say a couple of years ago, but I was saying it a couple of years ago. And it seems less silly now, but still a long way from the consensus view, I think. But the math is inexorable here. There's just no way around this. So,
And the technology problems that are being revealed on the renewable side are not insignificant either. We're seeing the wind turbine issues and other issues that are just not working out the way they planned. And now there's talk about using wood instead of steel for some of the turbines to help improve the performance. So there's a lot of things that are going to go over the next couple of years to get some of these industries better sized and better priced.
But wind is working in Iceland, and wind is working out offshore Holland, Netherlands. So and then they have a hydrogen market that they can create out of that. So it's transitioning, but there's just such a demand curve of energy that that's partly what's driving what.
There is some cost and failure issues, though, Mark, on the technologies that are creating some big problems. Siemens went to the German government, although they said they didn't really ask for $16 billion to help with their wind projects. Ørsted just announced some more challenges with their wind stuff as well. So it is working, but it's not a guarantee, and it's going to be fits and starts.
it's not working,
Chris.
It's not working. People are losing a ton of money on wind stuff right now. It's working in a few isolated places for particular reasons. But as a general statement, it is quite simply not working. Everybody's got their hand out for more subsidies. That's where this is.
Yeah, the scaling up is the challenge for it. You can do it on a smaller towers, but the bigger the tower, the bigger the problems.
Chris, do you have a view on YPF or anybody on Argentina here?
My view on Argentina is it's a nice place to visit and a bad place to put money. I mean,
Thank you.
That's a view I've had for a long time. So we started going to Argentina in 1995. And my shareholders were very upset with me in 1995, 1996, because a bunch of gringos bought production down in Argentina. And we didn't, because we did not think the pricing down there reflected the risk profile. And that was right in 1995. And honestly, I think it's still right. I think whatever the pricing is down there, you can't afford it. It's a place where it is completely acceptable socially and politically to take the foreigner's money. And it has happened repeatedly. And I think it's a good idea to learn from that. So,
Chris, the other thing is after they take the money and the Westerners or the guys with the technology leave, they haven't been able to keep it up to date. Have they fixed that problem at all, or is the infrastructure still crumbling down in many of those nations?
no, there's a lot of infrastructure problems down there. There are places where it's in better shape, Stephen, but on the whole, no, it's still a problem. I mean, this is an amazing story. I mean, this was like the fourth richest country in the world early in the 20th century. And it took them a very long time to run that country right into the ground, but they did it, you know. And I look at that, and actually I look at what's happening with the United States right now, and it scares me. I mean, I think people, it's time. It's time for us to wake up in this country. I don't understand why people think this can go on indefinitely. I really don't. So I would remind everybody what happened with Greece or Iceland or Portugal or whatever. Everything's fine, everything's fine, everything's fine. And then one day you can't sell the damn bonds. Almost on a day, you can't sell the damn bonds. And I'm afraid that's where we're headed here. on a 2 or 3 year time frame, unless we change course here.
Duncan, you're being very quiet over there. What are you thinking?
I am thinking it took an awful long time for people to realize that the global population is going to consume a lot of energy, and we need everything from everywhere. I agree with Chris on the oil thing, and people have just fought that over the years. Finally, you're having a real conversation. I think the real practical conversation is finally here, and but we've also moved to an environment where business models have to generate cash flow, and so that's true for everything. And so I think the energy production business is bifurcated on business models that count on subsidies and business models that have had to learn to operate on their own. And I guess I've been wondering if there aren't some opportunities in that the alternative space that have maybe gotten too beat up. I'd love to see any ideas there. It's very interesting what Exxon's doing, because the U.S. oil companies forever insisted they were oil companies only. I'd love to know on a board level if they are really trying to become energy companies instead of just oil companies. And I'm not sure a headline of them buying a lithium, little area of lithium is proof of that yet. That's what the European companies were doing, Shell and those guys, and their stocks always underperform. I don't know. I'm just rambling. I bought some cannabis stocks last week after I spoke to you guys. It's been a little bit of a rally. It's been disappointing, but
but it hasn't been as disappointing probably as it has for the last 2 years.
No, I mean, to me, it was like you got a second chance at the lows of the summer with the news much better because of what happened in the House. But God,
we were talking
anybody
about,
got any views on cannabis? I'm all ears. I feel like there's going to be money to be made here, but
what did you buy, Duncan, if I may? Yeah.
I bought True Leave. I bought some more True Leave. I bought Green Thumb. I bought Ascend. I bought, hang on, let me go to my little thing here. See here.
and anyone else active in the cannabis? I know some of you guys have been. Anyone else making this move?
Oh, Juicy. I bought some Juicy. That was like the smallest one. TerraSend in Verano. There you go. Anyway, I don't know. They're gonna, this whole rescheduling is gonna go through. If you read enough on it, it's a process. It's not a political process, and you're gonna wake up one day and it's through. But the interesting thing is, and I love if somebody understands the accounting of this, if they reschedule it in this calendar year 2023, does that mean all of the taxes for 2023 that have either been paid or accrued for are no longer due? In other words, the calendar year 2023 versus January 5th, 2024. I mean, I think it could be a pretty big deal when that happens for the balance sheets of any of these companies. And if you listen to some of the conference calls, a lot of them have stopped paying them. They've been accruing them. So I think the companies believe something's going to get done this year. And then the political process is of course, safe banking or something like that. And then you've got the enforcement of the illicit market. Anyway, you're pretty washed out. But anyway, I'm trying to figure. I'm determined to make money on this, and I'm all ears for any informed commentary.
Anyone have commentary?
Not informed.
No, every time I look at this, it looks like a mess to me. Can't figure out who wins and how they win. I can't figure out.
Yeah, I'm looking at my holdings and they moved up and then back down a little bit up.
Yeah, well, they're up a little bit today. It is a tricky one, but that's the beauty of it, right? I mean, the consumers are there. It's definitely a growth consumer market. And if you could switch the illicit market off and let these companies that are creating, real consumer product businesses, they'll have a big opportunity. And it's going to consolidate too.
I don't think you're going to switch the illicit market off. If you look at states like California and other states, what's happened is, despite the legal market, the illicit market has thrived because of the difference in the pricing, and that's put pressure on the legal pricing.
Yeah. But who's the winner? The government gets a piece of tax. If you suppress the illicit market, that's a revenue generator for the government, and the governments need money.
So
and the alcohol business was like this for a long time too.
Hold on one second, Mike. Britt, do you want to say something?
Yeah, I mean, I don't typically comment on the cannabis markets, but I happen to be with a group of people who own, they each own some pretty large licensed growing facilities and then distribution ones. And I was just adjacent conversation at the end of last week about it, and they were actually going on and on about how, because of the amount of regulations now and the taxing of having the licensed facilities, they were saying that the illicit market is actually growing faster than ever again now, because they're being taxed so much, and they're not making, like, the price, however they measure it, has gone down substantially. So people are actually now talking about stepping away from that and moving into psilocybin and mushroom and that side of things. And then they were just talking about how now they have to compete with the illicit market, while also not being incentivized to do it through the licensing and the regulations of the ones that they have licenses for. I had never really heard that side of things, but it's poignant for what you guys are talking about, for sure.
Michael, sorry, you want to finish your thought?
Oh, so I was just going to finish up by saying what I think I'm hearing folks here saying is we need another war on drugs, and I think the last one failed kind of miserably.